Good morning, happy Friday, and welcome to this week's episode of Sunrise Small Talk. This week we're going to talk about portfolio attribution. I get it, that sounds like kind of a scary phrase, but I'm going to make it as simple as possible. And the reason I want to talk about it is because several people have told me this year in the midst of all of this market volatility, hey, I've got more notifications, it seems like there's more trading going on. So what does that mean? I'll show you what that means. But before I dive in, next time you're in the office, I encourage you to look at these pictures and read the placards below them. They're not up right now, but we'll put them back up. Pretty cool stories about these folks who all passed away without an estate plan. So next time you're in, cruise on over here and read these. Let's dive in. Portfolio attribution, what does it mean? Well, in its the most simple definition I can think of for portfolio attribution is, did the research team and the investment committee do their job? You remember Bill Belichick probably 10 years ago, a lot of great Belichick dry quotes, but he said, do your job. Everybody do your job. And if you do your job, you win championships, and that's what happened. You know who didn't do their job is the Colorado Avalanche. I can't think of a lot of guys on the team who did their job, and we have no championship this year. No championship, no Stanley Cup in 2025, and I'm really upset about it, but I can't get into that because I gotta stay cool and do this video. Also, the flag is to my right now because thanks to Vern, a former Air Force veteran, he told me the flag always goes to your right when you speak. So normally you keep it over there, but I'll move it over here for the videos unless I forget, and if I forget, reprimand me. So portfolio attribution. What this means is just, are the moves the research team and the investment committee are making, are they benefiting you? Are we getting excess return above and beyond the benchmark? Now, a little disclosure, I will just say that I'm talking about the Carson House view, tactical models on average, so between the conservative, moderate, growth, aggressive, just looking at this on average. Now, you're not gonna log into your account and see exactly what I'm talking about here. I can't do a video on every single one of these because it would take all day long and nobody would watch it. So I'm just going to focus on tactical. I picked this one because tactical means they have less constraints, so they can bob and duck and weave a little bit more than some of the other models. So I thought it was a good representation of whether or not the research is paying off. So we have two main components here. We have selection and allocation. Inside each of those, we have four components, which I'm not going to go into. Things such as equity X factor sector, equity with factor sector, doesn't matter. I'm not going to talk about that because nobody will watch the video. Think of it this way. Allocation down below is your big pie chart, big pieces of pie. Selection up above is what are the toppings, what's the crust made out of, so on and so forth. So let's go through. I've got a green and a red marker, and we'll just grade this and see how it worked out. So number one, starting with selection. We actually got a minus here that did not add to the return of the portfolios on average, but then we got a plus, and a plus. I'll highlight down here diversifiers. The team's really big on diversifying the diversifiers right now. So what does that mean? It's things like managed futures, which are just contract swaps, things like that. Again, pretty that we can get into the weeds on that. I'm not going to do that. Gold. I will highlight gold though. Gold is inside the diversifier section. And here's what's nice about gold. It's up about 50% over the last year. We've had gold in the portfolio, I believe, that entire time. What I do know is that in November after the election, there was a sharp decline in gold. That was a buying opportunity. So we took the opportunity there, bought some more gold, increased the position in gold. And guess what? It was like the best quarter since 1986 for gold. So pretty cool there. Also, before I go into the allocation side of things, people have asked me, I'm getting more trades, I'm seeing more trades. That's just because it's volatile, so we're going to rebalance. We're going to stay in our tolerance bands, which triggers more rebalances, look for opportunities such as gold plummeting right after the election. That's a buying opportunity. Also, with the volatility, just looking for ways to play a little more defense in some portfolios. So that's why you're seeing more emails, trade notifications. Okay, on the allocation side of things, we had a minus, minus, and then in the size, we had a plus. So put it all together between these 8 categories. What did that do for the portfolio? Now the numbers I'm going off of are a little bit out of date because the market has been crazy, but let's just call it right about Q1. What did the minus, the 3 pluses, and then down here the 3 minuses and the plus, what did that do? Well, it was a plus about 50 bips or basis points, so 0.5%. I think it was actually 0.52, but let's just call it 0.5% because that'll make my math easy. So again, we're just going to call that about Q1 because that was pretty close to the time this data was shared with me. So if we extrapolate that out for the rest of 2025, 0.5 times 4 obviously would be 2%. So if all things were equal in this scenario, which they won't be, but let's just say they are, let's just hypothetically say everything is equal, and this continues for the rest of the year, then we beat our CHV tactical models on average, beat their average benchmark by 0.5% times 4, 2%. So there you go. Never would I tell somebody that we are going to double what the market does or beat the market by double digits every single year, but it's these incremental changes that can prove to add a little bit of alpha, which is excess return above and beyond the market. I'm going to show you what this looks like. I'm going to flip the camera around here, show you on the TV what this actually looks like, real data year to date. Again, your statements, your numbers are not going to match this because portfolios are different, customized, all of that good stuff. Just speaking generally here. So flip it around. Actual live numbers for the last year. Purple line is Carson Houseview Tactical Moderate, which is just an average moderate portfolio on the tactical side of things relative to the moderate benchmark in the orange. So over time, just looking at the alpha that's been generated, again, return over benchmark. Benchmark is at 7.66% positive return over the last 12 months, and the portfolio is at 10.94%. So again, you make these little incremental changes over time, and it can, of course, no guarantee of future performance, all those disclosures, all that good stuff. But if we look at the live data, the moves tend to pay off. So Bill Belichick would be pumped. And again, the Avalanche, what the heck, man? Just can't believe the meltdown. Okay, hope that was helpful. Hope that answered some questions. Take care. Have a great Friday, great weekend, and we'll see you next time.